Welcome to PhillipCapital Weekly Market Watch. I'm Ming, equities dealer from Marine Parade Dealing Team. In this week's Market Watch, we will discuss on the impact of US import tariffs that was recently announced by US President Donald Trump and the potential impact on the market. I will also be covering on the technical perspective of the three major indices towards the end. Do take note that this video is purely for educational purpose and it does not constitute to any buy or sell calls. Last week, Donald Trump signed an agreement to implement US import tariffs for steel and aluminium. Currently, only two countries are excluded from these new tariffs, which is Canada and Mexico. After its announcement, fears of trade wars escalate and markets reacted negatively to it. It is understood from recent history that trade wars usually has a negative impact on the market as it restricts trade and growth. From this chart, we can actually tell that the top major exporters to US are South Korea, Brazil and Russia. We can expect a bigger impact to these countries' steel exporters. Countries' trade representatives are actually hoping to negotiate deals to prevent trade wars from happening. Currently, the US steel import market share stands at about 27%. From this chart, we can also see that the US import on steel has been steadily increasing over the past 2 decades. This is likely caused by the competitive pricing offered by exporters as compared to purchasing steel from local manufacturers. This has resulted in a decline of steel manufacturing industries in US over the past decade. Now let's talk about the impact the tariffs has on the global economy. Demand for domestic steel will increase, which will drive prices higher, and the high prices will ultimately be passed on to the consumer. Other countries might retaliate by increasing tariffs charged to US imports, which will cause an endless cycle of trade wars, and this will definitely benefit no countries in terms of growth. Initial concern was that the tariff was targeted to China, as they are one of the larger exporters of steel, but statistics as shown in the previous chart states that imports from China steel only make up 2.9% of the total US steel imports. There is also a study conducted recently predicting that there will be a net loss of jobs, as tariffs were likely to add more jobs to the US metal sectors. The rest of the economy may eventually suffer a bigger loss in jobs. Currently, market has yet to fully digest the agreement that US President Donald Trump has signed, as there are still ongoing negotiations for countries looking to be exempted from the tariffs. For the industry that will benefit from the tariffs will be the US steel sector. Tariffs will reduce the demand for imported steel, which will increase demand for domestic steel, allowing for the US metal sector to expand. US steel employment has fallen for the past 3 decades, so by introducing tariffs on imported steel, they hope the situation will improve. But consequently, the steel consuming industries may be affected. Industries such as the car, airplane, heavy equipment manufacturers, as well as the construction business. They are forced to switch to locally produced steel, which may result in higher costs, and also due to the lower supply of steel from the lesser imports. In conclusion, tariffs may be a headwind for the economy, and it should be something that we should look into moving forward. So now let's take a look at the technical perspective of the Straits Times Index. Currently, we are seeing the STI trading at around 3,520 points. The current uptrend remained intact since November 2016. The high of April 2015 has been broken, and we should see STI continue to track up towards the 3,800 to 3,900 points region. Technical indicators such as stochastic oscillator may be used to identify oversold opportunities as shown in the chart. For Nasdaq, it has broken the all-time high set in January 2018 and looks set to continue the uptrend after the market correction last month. We can use the 200-day moving average as a support for the bigger trend, and the 20-day and 50-day moving average may also be used to identify any potential changes in the market trend during the short term. Hang Seng has also broken all-time high and has still remained on a trend line since January 2017. The same may be applied by using the 200-day moving average as the support for the major trend, and 20-day and 50-day may continue to act as a short-term resistance or support. Investors who are interested to trade market indices may use our Phillip CFD tradable indices, which offers a comprehensive list of indices for trading. With this, we have come to the end of this week's Market Watch. Do remember to subscribe to our PhillipCapital YouTube channel for our weekly Market Watch. You may also visit our website for more information. Thank you for watching.